Welcome back. CNBC Today reports Fed recap. Powell shoots down March rate cuts. We had a Federal Reserve interest rate decision today. They left interest rates unchanged. The Fed is unlikely to start cutting rates in March. And in the year 2024, expectations, the Fed's only going to cut by 75 basis points. It's a lot less aggressive than a lot of us thought just a few weeks ago. Chairman Powell said in part, we've had inflation come down without a slow economy and without important increases in unemployment. Speaking of employment, non-farm payrolls, the last report was 216,000 jobs. We've seen a steady move to the downside. 216 is on the lower end. He is correct. Chairman Powell is correct in saying that unemployment has not increased. But then again, it's not really the non-farm payroll, at least it's not at a great position. Strong economies, we see 300, 400,000 new jobs. It'll be very interesting to see what the jobs number looks like at the end of this week. Irregardless, we see a steady trend to the downside in the jobs market, but the Fed says jobs are not to worry about, and we have bigger fish to fry. He says continued declines in inflation are really the main thing that we are looking at. Here's a PCE, personal consumption expenditure. This is just the other day. It's moving in the right direction. It's not at the 2% level yet. And the Fed said today they are not going to cut rates until we see 2%. It's still their goal. Now, speaking of the March meeting, we saw much higher expectations of an interest rate cut in the March meeting just a couple weeks ago. It was at 77%, now 37%. White line is the S&P 500. Now, it was trending to the upside, but that was under a different situation. It was trending to the upside under, in part, the assumption the Fed about a 50% chance that it was going to cut rates. That is no longer on the table. Now, the bond market really tells us a whole story. The green line is 1 year US Treasury, pink line 10-year. The white bars represent the spread between the two. Now, in particular, notice late December, early January, we had a relatively wide spread. That began to narrow. Did the 1 year Treasury, did the green line go down? Not so much. It was all in the 10-year. I think the whole story is in the 10-year bond. It started to trend to the upside. Now, remember why these bonds move. Short term bonds, like the 1 year, move more in anticipation of Federal Reserve interest rate decisions, what the Fed is going to do. Long-term bonds like the 10-year, the pink line, move under the prospect of a strong or weak economy in the future. Short-term bonds talk about the Fed, long-term bonds talk about the economy. Now, we saw contraction in the spread because the 10-year yield was rising. We had some good news. We had strong retail sales numbers. We had a 3.3% GDP number. That was good. So, with the expectation the Fed had about a 50% chance of cutting rates, we also had a strong economy. But now that has changed because now the Fed has taken that 50 or that 25 basis point cut off of the March meeting. So now we see that the economy, or I should say the market, the bond market is waking up today to the new reality that we're going to have higher interest rates for a longer period of time and not just March. We may only see, according to the Fed, 75 basis point cuts over the next year, 3/4 of 1 percentage point. So that's why we see the 10-year bond selling off, and that's why we see the yield going down. And by the way, that's also why we see the green line, the 1 year, not going down. Remember, the 1 year, look to the next interest rate decision. That's not down. So the green line is straight, the pink line is down, and that's why that spread is widening. Now here's a 10-1 spread in white, green line S&P 500. Now the stock market was going up under the anticipation, again, that we had about a 50% chance of a Fed cut and a strong economy. Now, that was the anticipation. We had an economy that was growing, and we had the Fed that was most likely to cut rates in March. But now it's a new paradigm. We're now working under the assumption that, well, the economy, at least right now, is what it was last week, strong, but the Fed is now taking Fed cuts off the table, at least for March. Well, I'm sorry, the 10-year bond is going down. The 10-year bond going down is dragging the spread down. It's widening the difference between the 10 and the 1 year. And that is also in part due to the fact, again, the market is realizing that we're going to have longer, higher interest rates for a longer period of time. And stocks also, by the way, are not a fan of that either. Here is the pink line. That's the Treasury spread, the 10-1 spread. The green line is the March meeting. Specifically, what are the probabilities that the Federal Reserve is going to cut rates in March? Now, we see that contracting and this is beginning of January. We saw the 10-1 spread begin to rise because the economic numbers are getting better. A couple of weeks ago, we had some really nice retail sales numbers. Now, we had retail sales numbers, but we're also working under the anticipation that the Federal Reserve is going to cut rates. It was at 77%. It went down to just under 50%, but there was still a possibility. And more than that, I think that the market had a great deal of comfort because it said to itself, market said, okay, the economy's strong, and that's why the Fed's not going to cut rates. But we have that safety. We have that seatbelt that if the economy starts to weaken, the Fed will cut rates. And that's why when the green line, the Fed March meeting probability of a cut went down, well, that sent the market a signal. Yes, there's less of a chance the Federal Reserve is going to cut rates, but that's actually a good thing. It means that the Federal Reserve sees strength in the economy. But now the paradigm has shifted. Now we see that the probability that the Federal Reserve is going to cut rates, that's a green line, that's flat. That's not going down. But the pink line, the 10-1 spread, that's going down because the bond market again is waking up to the fact that maybe the Fed is not going to be there to rescue us. You know, in a crisis, of course, but it's going to take more. And I think this is really the key. The takeaway from today's meeting is the Fed is less likely to respond to bad economic numbers. It's not going to be as reactive. The Fed said, yes, I know everybody thinks we're going to cut rates. No, no, no. 2% inflation target. That's our focus. And by the way, we're not concerned about 216,000 non-farm payroll. That's okay for us too. Green line, March meeting. Again, chances that the Federal Reserve is going to cut rates. It was at 77%, came down to 46, now 36 and a half. The red line or pink line is the 10-year U.S. Treasury. And in particular, this is what's happening now that the Federal Reserve is less likely to cut rates. And now, because it's less likely to cut rates, the Federal Reserve is less likely to help us out. And if the economic numbers start to look poor, well, they're not going to be as reactive, at least as much as we thought they were going to be 2 weeks ago. Perfect transition, by the way, because now as we move closer to the idea about the Federal Reserve eventually cutting rates and under what circumstances, we want to ask ourselves a question. What's the next step? How will the markets respond to interest rate cuts? We're running a race. Will the inflation rate hit 2%, its 2% target while the jobs market is still good? And then the Federal Reserve will cut rates? Or will the jobs market fall apart before we get to a 2% inflation target? So is the Federal Reserve going to cut rates for a good reason or a bad reason? Well, left-hand side of the chart, that's 1991. That was an example of a good situation. That's when the Federal Reserve cut rates just enough and at the right pace to slow down the economy. Notice the white line, the S&P 500, didn't go down that much. It was actually not very volatile at all. And the Federal Reserve was able to cut rates, save the jobs market, save consumer confidence, but still lower inflation and create an environment for the fantastic times of late 1990s. Compare and contrast that to 2008, the opposite situation. Most most people think that the Federal Reserve probably waited too long to cut rates. Maybe they didn't cut rates fast enough. There was a lot, going on at that time. Nevertheless, we know what happened with the S&P 500, huge collapse. So we studied, and this is called a hard landing, by the way. 91 is a soft landing. 91 is what we want. So we looked at a number of the most important economic numbers to watch in order to determine what does a hard landing look like and what does a soft landing look like, including what did the GDP numbers look like? What did the unemployment rates? Consumer price index, that's inflation. Housing starts. University of Michigan consumer sentiment. We take a look at all of these numbers under the situation of a soft landing and a hard landing in order to create the template to prepare us for what's coming next. And, we can look at the economic reports as they come out over the next few weeks and months and, even after that. And it's very important that we know whether we're going to have a hard landing or soft landing because stock markets behave in very, very different ways. In 1990, 91, 92, the stock market was not very volatile and it laid the groundwork for a tremendous bull market after that. In 2008, the hard landing caused quite a bit of damage to the markets and the economy. So the real benefit of this is it prepares us and again creates a template so we can look at the economic reports, such as non-farm payroll this Friday, and we can get a better idea of maybe what's to come. This is published for free in our Substack newsletter. We'll provide a link in the comments of this video. It's a very interesting read. I think you'll have a good time reading it. And as always, we're going to watch the economic calendars. We have a lot going on: construction spending, ISM manufacturing, and non-farm payroll. That's only this week. And we'll be sure to update you along the way with any significant changes. And we'll be back very, very shortly with more great news to come. We hope this has been helpful. We look forward to seeing you back soon.